Hey y'all, we're back with our Crypto 101 series, and we're going to be going over the second largest cryptocurrency after Bitcoin, and that's going to be Ether. Even though it's the second largest cryptocurrency, it has way more utility than Bitcoin. It's not just used as a digital currency, it literally runs an entire platform. You make your apps with it, you pay with every single thing on the platform with Ether. And again, Ethereum is a platform and Ether is its native currency. Okay, you guys? So let's go ahead and jump into that so you can know everything there is to know about Ether. Okay, you guys, so Ether is the built-in currency on the Ethereum network, also known as the native currency. Now I'm going to give you the textbook definition of Ether. So it's going to be, like Bitcoin, it can be seen as a digital asset to store or transfer value on the blockchain. Its main use case is to facilitate the computation of smart contracts and decentralized apps on the Ethereum network. Anyone looking to build software on Ethereum has to pay for the computing power with Ether. An Ethereum node has to execute a transaction on the network, and it isn't going to do it for free. Without Ether, you can't do anything on Ethereum. So it sounds like Ether is pretty important, right? The Ethereum Virtual Machine, or EVM, which I went over in my last video, so if you haven't already, go ahead and check that out. But with this EVM, it can literally compute anything that you give it. Anything that you give it, it can make it come to life, okay, on the Ethereum network. But the only thing with that is it's a turning complete machine, which means that it doesn't know when to stop. So it will just keep on going and going and going. As you can see, this would be a huge problem because it would cause a lot of congestion on the network and it will cause a halting problem on the network. Now, this is where Ether comes into play, and which is why it is so important. So I'm going to take this one straight from the textbook. To discourage malicious actors from running code with infinite loops or spamming the network with computation-heavy contracts, Ethereum imposes transaction fees paid in Ether in order to run smart contracts. This requirement makes Ether a key mechanism in keeping the demand for computational resources on the Ethereum network in check. So right alongside Ether, you're going to have what they call gas. And gas is just essentially going to be the measure of units needed to be able to have this computer power and to run the smart contract successfully, okay? So to put this in real life perspective, you can look at this as like gas in a car. Now, gas and Ether are two separate things, but they are close in correlation. So in order to start a car, you're going to need gas. On top of that, if you have a bigger car with a bigger gas tank, you're going to require even more gas. Or if you're going to put this car to work and have it drive long distances and actually put it to work, you're going to need even more gas. Now, this can be seen as the same exact way on the Ethereum network when it comes to smart contracts. If you have smart contracts, you're going to literally need gas units in order to create that smart contract. The more you ask the smart contract to do, the more gas it's going to need, the more computer power it's going to need, the more energy it's going to need, you guys. So the bigger the project, the bigger the smart contract, the more gas units that are going to be used. Now, again, gas is different from Ether, but both are used in correlation with each other. Without Ether, you cannot have a smart contract. You cannot do anything on the network, okay? Now, Ether is the currency that it works with, and gas is the calculation of computer power needed to keep these smart contracts running. Now, gas is not going to be your only fee that you're going to be paying on the Ethereum platform. You have gas, you have your base fee, you have priority fees. So the gas price is going to be paid in Ether. It's not going to be paid in another currency. It's going to be paid in Ether. So the way that you can look at this is the amount of gas that it takes to do this smart contract. You have to transfer that over into the amount of Ether that you're going to be paying for the amount of gas that you're going to be using for the amount of computer power that you're going to be using. So it's like a full circle type of thing. So because miners can be able to decline a transaction if the gas price is too low, the gas price has to be high enough to outweigh the computer power that they themselves are going to have to use to complete this transaction. Now, the network does have what you call gas limits, which is literally a limit on the amount of gas that you're willing to pay to complete your transaction. Now, this is really nice because it stops you from paying way more than you budgeted for. Also, on top of that, it stops anything faulty happening for you to have to suddenly pay more because the fees suddenly increased on you. That has nothing to do with you, the fees suddenly increasing, okay? You budgeted how much you wanted to pay, and you're going to pay no more than what you budgeted to pay and what you set your gas limit as. But I do have to mention, just like if you don't have enough gas for your car, it's going to turn off and it's not going to work for you. This is the same exact thing. If you don't have enough gas units, the transaction will not go through and it will not work, okay? If you run out of gas, it's not going to work, okay? Even though you spent money on it already, it's still not going to work because you didn't have enough, and you're not going to get that gas back. The gas that the validators use to be able to start that transaction and begin on that transaction, they already used it. So they're not going to make the validators pay you because you ran out of gas. No, you're just not going to get it back. And this is because validators earn by validating onto the blockchain. They don't earn by how much gas they spend to do the transaction. They earn by actually validating and adding it onto the blockchain. But the positive thing about this though is that most crypto wallets automatically calculate the gas needed for you. You don't have to calculate it, okay? But again, you can always set limits so that it doesn't go over what you say you want it to be. Now, like I said, there are a lot of fees that come with the Ethereum network. You have your base fee times your gas unit fee, and then also a priority tip. So if you want your transaction to go through fast and everything like that, you're going to have to tip the validator. The more that you tip the validator and things like that, it's going to be an incentive for the validator to complete your transaction faster. Now you may be thinking, oh my gosh, Ethereum has all these fees when there's other networks like Solana who has fees for like a cent or less than a cent. Why not just use Solana or something like that? Well, that is a bright idea, and that is what these Ethereum developers also thought as well and what they noticed. So that's why we're going to have layer 2 solutions, which is going to make it faster and less expensive for you to be able to add things to the blockchain. So what layer 2 does is it's going to take these transactions off chain and then put in the computer work needed to be able to complete these transactions, so that you're going to have less fees, it's going to be faster, and on top of that you can have more done at one time, okay? So the transactions per second is going to be way faster on these layer 2 solutions. Now, layer 1 is the original foundation of Ethereum. That is still one of the main ones used, okay? But layer 2 is now being adopted a lot more by users, okay? And also because it's off chain, it's going to be less congestion in the Ethereum platform, in the Ethereum network, okay? Which is going to be great because Ethereum has had some points in time when it was congested. But the security of these transactions in the blockchain is still going to be intact. It's just going to be making it faster and less, okay? So now I'm going to give you the textbook definition for 3 types of layer 2 solutions. Now, the first one is going to be roll-ups, like a fruit roll-up. Okay, roll-ups. These bundle up or roll up hundreds of transactions into a single batch, submitting them to the L1 to drastically lower fees. Then you have state channels, and this allows users to transact off-chain multiple times with only the initial and final states recorded on L1, okay? Now we have side chains, independent parallel chains that connect to Ethereum via bridge, having their own consensus mechanisms. So all of these working together are layer 2 solutions, and these like started coming out like in 2018, but they started like getting a lot more popularity in like 2020, 2021, 2022. Okay, but now they are super popular now. Okay, you still have layer 1 because that is the foundation of the Ethereum network, but they are transitioning over to layer 2 solutions because it has so many more benefits, and at the same time it's still secure. Okay, now let's go over the price of Ether. We went over the price of gas and gas units. Now we talk about the price of Ether. And one thing that I do want to say is that Bitcoin and Ether historically have followed right behind each other. So when Bitcoin goes up, Ether is right behind it. When Bitcoin goes down, Ether is also right behind it. Now lately it has been forming its own trends and becoming a little bit more independent as far as price action and not following Bitcoin, but it still tends to like trail after Bitcoin and the things that it's doing. But at the same time, it's gaining its own independence and its own type of market structure, I guess you could call it. Now, when technology stocks are doing very well, you're going to see a stock in the Ether price. And this is because investors are seeing this more as an investment than just like a digital currency. Because again, Ethereum has a lot of utility behind its platform, and because Ether runs this platform and it's the form of currency used in this platform, investors are seeing this as an actual investment, okay, inside of like technology itself. Now, that's also vice versa. When the technology sector is doing bad, tech stocks are going down, you're going to see a decrease in the price of Ether, okay? Because again, they're viewing Ether as a technology with all the sectors and everything along with it, okay? Not just as a digital currency. Now, something else that has a heavy impact on Ether's price is going to be government regulations, okay? The more regulations that are put into place and policies that are put into place about monetary policies, and it doesn't just have to be put against crypto, just monetary policies in general, the more it's going to affect Ethereum's price. The more regulations and policies you have, the lower in price Ethereum is going to become, especially when these policies are directly impacting cryptocurrencies. Because you have to remember that cryptocurrencies were meant to be deregulated and decentralized. So when you're placing all these regulations and rules on top of it, it's making it more into a centralized type of cryptocurrency. And people don't really want that. The less regulations they have, the more volatility you're going to see inside of the market. The more regulations they have, the less. Now, the current regulations that are into play when it comes to Ethereum and other cryptocurrencies like XRP as well, is that the SEC is trying to see if they can label it as a stock or a commodity, okay, or security. They have to label it as something in their opinion because Ethereum has so much utility behind it, and it's actually being traded and it has value. You can store value inside of it and it has so much utility behind it, okay? But there's a lot of like discrepancies because the different people who are making these decisions actually see them as different things altogether. And I'm gonna go over what I mean by that. So the SEC views Ethereum as securities. But of course, because they're the securities exchange, right? They want everything to be security so they can benefit off of having regulations on it and they can control the markets. But the Commodity Future Trading Commission views it as a commodity, something like gold, okay? And of course, that's because they want to benefit off of it and they want to be in control of the Ethereum market. Now, the IRS is just randomly coming in here talking about, nope, digital assets are seen as property for tax reasons, of course. Now, if it is placed inside of one of these categories, you know, it's going to have the same regulations as those categories. So like with equities and securities, it's going to have the same rules as like stocks. And if it's placed as a commodity, it's going to have the same rules as like gold or something like that. So it's just like, no matter which way they want to put it, it's going to be regulation placed on it. And I personally believe that's because Ethereum is such a big network. It has so much utility and they just really want to control it because it being decentralized and them not having control over something that powerful, I'm sure it doesn't sit well with them. You guys, XRP went through the same thing. They had a year's worth of lawsuit going through the same thing. You know, the SEC saying it's securities and then other people saying, no, it's not securities. It's just like a lot of things going on. Now that lawsuit did end and I will update you on exactly what happened on that when I go over XRP. Now, something else that's going to heavily influence Ether's price is going to be economic data, inflation, and interest rates. Now, I did research the correlation between like interest rates and inflation and how that has an actual impact on the crypto market, just so you can have an accurate, like detailed understanding of it. And I wrote it down for you guys. So, when growth and inflation are high, the markets tend to speculate that central banks are likely to raise interest rates to slow down a hot economy, making investors move away from risk assets like crypto. When growth and inflation are low, the markets tend to speculate that central banks will likely lower interest rates to ignite a slow economy. Tends to push capital towards risk in assets, aka crypto. Investors focus more on inflation, okay, you guys? So no matter what's going on, there's all these things going on, investors are going to focus the most on inflation because that's a key indicator in their eyes of what the central banks are going to be doing and what the economy is going to feel after the central banks do what they're going to do. Now, I do have a video on my YouTube channel talking everything about interest rates and inflation and how it has an impact on the economy, but I will give a little gist of it here as well. So, when you have a very high economy, the growth is really high and there's inflated prices and things like that, they're going to want to cut down on the amount of money in circulation and give money its value again. So they're going to essentially higher interest rates, okay? So they're going to make it more expensive for you to borrow because the interest rate is just essentially how much you can pay to be able to borrow money. Now, when the economy is doing bad and they're just slow, just not doing good at all, they're going to want to stimulate some growth. So they're going to lower interest rates to bring more money into circulation to allow you to borrow money for a cheaper price. Stay with me, you guys, because I'm saving the best for last. In my opinion, the thing that has the biggest impact on Ethereum, on the Ether's price, is going to be staking, you guys. And I know you're like, staking? What? I thought staking was good. Yes, staking is good and it makes everything faster, but it also comes with a cost. So when Ether is staked by these validators, it's going to temporarily remove it from supply, okay? So it's not going to be circulating anymore. So that means less supply, okay? And that means it's going to make the price go up even more because there's less in supply. You got to remember, The more you have, the less money it's going to cost. The less you have, the more money it's going to be worth. As of 2026, there is over 36 million Ether staked and taken out of the supply chain, out of the circulation, okay, you guys? And that equals up to 30% of circulating Ether. 30% of Ether is staked. 36 million Ether are staked, which correlates to $118 billion worth of staked Ether. And you may be thinking, that is so much Ether being staked. Why? Well, the reason is because these validators are getting paid to stake this Ether. They are getting paid an annual percentage to stake this Ether. So the annual reward rate is about 1.9 to 3% they're getting back on this staked Ether. So the more Ether that you stake, the more money you're going to get in return for not doing anything but just putting your Ether away. Now, due to a mechanism called EIP 1559, it's going to be taking those transaction fees, which are Ether, a percentage of those transaction fees, and permanently destroying them, permanently burning them and taking them out of circulation, okay? So that is just also influencing Ether's price, because there's going to be more being burned than there's going to be created. Now, this makes the total supply deflationary over time, and I'm going to go over the textbook definition for deflation. Deflation is a sustained decrease in the general price levels, increasing the purchasing power of money. Pretty smart, right? I mean, really, the Ethereum network, with all these updates and everything that it's got going on, it just keeps bettering itself, okay? Now, it does have like really tough competition like Solana, you guys. But Ethereum is still the second largest cryptocurrency network. So I think it's going to be okay for now. Now, you guys, that is all things Ethereum. We went over all the main and the little bitty concepts of Ethereum and Ether, okay, you guys? We went over this for about over a week, right? We were studying Ethereum, okay? Now, we are moving on to Solana. And I had so much fun researching about Solana because I think the utility behind Solana is insane, okay? As far as like prices and speed and everything, it's actually insane. So come back tomorrow as I introduce Solana to you guys, and I think you're really going to love Solana because I fell in love with Solana. I thought I loved Ethereum, but now I'm in love with Solana. Oh my god, I can't choose. Did y'all know that Solana has a phone? Like an actual phone. My phone's not in here, but an actual phone, okay? It gets real, okay? We're gonna be going over all of that. But before I go, you guys, always remember that pretty girls can do crypto too. Toodles.